Gold is approaching a major liquidity zone where smart money is heavily positioned for the next macro move. My primary focus today is a massive bearish setup resting just above key liquidity. But there's one strict condition that has to happen first. Let me show you where institutions are actually targeting, because most retail traders are looking at the exact wrong level right now.
My overall directional bias remains firmly bearish, and this precise number, 4021.55, is the main sell-side liquidity target institutions are engineering price toward. It's a magnet. The entire institutional order flow we're about to decode is designed to drag the market exactly to this point.
Before we even look at a chart, here's today's exact executable trading plan. I want you to know exactly where the opportunity exists right from minute one. Our daily bias is bearish. The primary setup is to sell inside a precise premium zone between 4068.50 and 4073.50. The invalidation level, where this entire thesis is proven wrong, is a hard close above 4079. And our ultimate target is that 4021.55 liquidity pool. Now let's break down exactly why smart money is targeting this area.
Looking at the daily time frame, you can clearly see the macro narrative. Smart money has been executing a multi-month distribution phase from the early 2026 extremes. They've been successively printing lower highs and lower lows, breaking significant swing highs and dropping price deeply into discount territory. We're in a clear institutional downtrend.
Zooming into the H4 chart, we see the micromechanics of this downtrend. This recent upward movement you're seeing is merely a short-term corrective rally right into a supply zone. It's a classic internal premium rejection. Price is currently oscillating near the equilibrium of the dealing range, failing to sustain above mid-4080s resistance. Institutions are using this consolidation strictly for internal range liquidity engineering.
To understand the timing of these structural moves, we've got to monitor the macro volatility catalysts. Ongoing geopolitical tensions between the US and Iran over the Strait of Hormuz, with clear threats to global energy supply chains, injects a significant risk premium into the markets. Additionally, reports of Fed Chairman Kevin Warsh considering a reduction in FOMC rate-setting meetings from 8 to 6 per year marks a major shift in the monetary policy framework. These are the underlying volatility engines institutions will use to drive price to their intended targets.
With that volatility in mind, let's look at where institutions are actually targeting on the H1 timeframe. Notice the massive open bearish fair value gap resting just above current price, squarely between 4068.50 and 4074.00. This is an unfilled imbalance created during the recent sell-off. It acts as an immediate, high-probability premium supply zone.
But here's the problem. To understand how the market will reach that target, we have to think like an institution and ask ourselves, where are retail traders placing their stops right now within this consolidation? Where exactly is the trap? Because as we know, the market's primary job is to prove the majority wrong.
The answer lies in the liquidity mapping. Retail traders are leaving clean buy-side liquidity, or buy stops, just above 4667.30 and 4076.45. Meanwhile, on the downside, smart money has purposely engineered extremely vulnerable equal lows, or sell-side liquidity, down at 4021.55. These repeated retests at the bottom without a structural shift higher are a massive warning sign. Those equal lows are the true institutional draw on price.
This brings us to the actual M15 execution model for our short position. If price behaves as anticipated, selling inside that premium fair value gap offers a phenomenal 4.7 to 1 risk-to-reward ratio. You enter near 4070, place a strict stop loss at 4078.50, and scale out at 4049 and 4030, leaving a runner for our ultimate target down at 4021.5. However, smart money confirmation requires strict discipline. You don't just blindly sell when price hits a level. You must wait for these exact 4 steps to unfold before ever pressing the sell button. First, we need a clear sweep of the buy-side liquidity above 4067.30. Second, a tap into the H1 bearish fair value gap. Third, a strong M15 market structure shift to the downside with energetic displacement. And fourth, you enter on the retest of the fresh M15 fair value gap that gets left behind.
Right now, on the M15 time frame, those conditions simply have not been met. Price is just consolidating in the middle of a local range near 4060. There's no active liquidity sweep, there's no market structure shift. That means no institutional confirmation exists right now. You just have to sit on your hands and wait.
And this is exactly where most retail traders get trapped. They completely lack the patience for confirmation. But the market is sending a warning signal about tonight's session. So what happens when the high-impact USD JOLTS Job Openings data drops at 9 p.m.?
Institutions frequently use major news events as a liquidity catalyst. They're preparing to use the JOLTS data to engineer a textbook Judas Swing. This is the ultimate retail trap designed to accumulate counterparty liquidity right before the real move occurs.
Here's how the Judas Swing functions mechanically. First, institutions hold price in a tight multi-session consolidation during Asia and London hours. Second, they use the JOLTS news volatility to intentionally spike price upward. Third, this fake breakout surges past 40.67, triggering retail buy stops and trapping those breakout traders. And finally, once that buy-side liquidity is absorbed into the premium supply zone, heavy institutional displacement drives the market violently downward.
This dynamic completely changes everything you're looking at on the chart. The retail perspective sees a bullish breakout on strong news and blindly buys the momentum. But the institutional reality is entirely different. Smart money sees a calculated sweep of internal buy-side liquidity straight into premium supply, allowing them to execute massive short positions at the best possible price. They're perfectly positioning themselves to drag the market down to our ultimate target.
While our conviction is high, professional trading requires objective risk parameters. You must respect the invalidation level. If an H1 candle firmly closes above 40.79, the bearish order flow is definitively destroyed. At that point, the setup is nullified and an alternative market path opens up toward the next major swing highs at 41.17. We don't hope in this business, we simply react to structural invalidation.
To quickly recap our explainer today, our higher time frame bias is bearish. We're waiting patiently for a sweep of 40.67 to short into our premium supply zone. Our primary target is those engineered equal lows at 40.21.55. And most importantly, you must strictly manage your risk, risking a maximum of 0.5% to 1% of your account equity on this specific idea.
If you appreciate this level of institutional-style market analysis using smart money concepts, and you want to continue mapping liquidity and order flow alongside me, be sure to subscribe to the ICT Market Theory channel. And if you'd like to trade alongside these setups on a professional platform, you can find the FXTM account link in the pinned comment below. Remember, wait for your confirmation, protect your capital, and let the institutions reveal their hand. The only question left is, when the Judas Swing happens tonight, will you be the one trapping or the one getting trapped?